Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of business filings, and today we're diving into Dune Acquisition Corporation IS latest 10Q report. If you like your financial news with a side of spectacular uncertainty, then this is the video for you. And hey, before we jump in, if you're enjoying these deep dives into corporate documents, make sure you're subscribed and hit that notification bell. Also, we've got a fantastic community over on Discord, linked in the description below, where we chat all things business and finance. Come join the conversation. So what is Dune Acquisition Corporation 2 anyway? Think of them as a SPAC, a special purpose acquisition company. They exist to raise money, then find another company to buy, essentially bringing that target company public. They've just filed their quarterly report for the period ending the 30th of September 2025, and it's full of the usual SPAC, speak, and financial gymnastics. Let's start by looking at the company's financial snapshot. Their balance sheet. On the asset side, we see cash and cash equivalents have drastically increased, from just over $13,000 at the end of 2024 to over $400,000 by September 2025. This makes sense given they had their initial public offering in May 2025. The big number here is the marketable securities held in the trust account, which balloons from zero to over $146 million. This money is set aside to find a business to combine with. On the other side, liabilities. Total liabilities are about $5.8 million by September 2025. A significant chunk of this is a deferred underwriting fee payable, which is a whopping $5.75 million. This is essentially money they owe to the underwriters, to be paid later upon the completion of their business combination. Now, this is a critical part of a SPAC's balance sheet. Class A ordinary shares subject to possible redemption. This represents the shares bought by the public in the IPO, which can be redeemed for cash if the shareholders don't like where the company is heading, or if a business combination isn't completed. Here, it's a massive $146.5 million. This is essentially the money from potential public shareholders that the company holds, but has to be ready to give back. And the shareholders' deficit, essentially the company's net worth, is a negative $5.3 million. This is typical for a SPAC that has not yet completed its business combination, as they have expenses but no significant revenue. Moving on to how the company performed financially, for the 3 months ending the 30th of September 2025, they reported a net income of about $1.3 million. This isn't from operations, mind you, but from interest earned on those marketable securities held in the trust account. They also had formation and general administrative costs of around $179,000. For the 9 months ending the 30th of September 2025, the picture is similar but bigger. A net income of over $2 million driven by interest income on those trust account assets, offset by about $340,000 in formation and administrative costs. For the very short period from their inception in September 2024 through September 2024. They actually had a small net loss of just over $16,000. When we look at earnings per S-Hair, for the 3 months of 2025, it's 7 cents for Class A redeemable shares. For the 9 months, it's 16 cents. And for the non-redeemable Class A and Class B shares, it's also 7 cents and 16 cents respectively for those periods. These numbers are heavily influenced by the interest income from the trust. Let's check out the cash flows for the 9 months ending the 30th of September 2025. The company used about $393,000 in operating activities. A big chunk of that reflects the interest they earned on the trust account, which is shown as an outflow here because it's not cash generated from normal business operations. They also had significant investing activities, using over $144 million to invest in their trust account. On the financing side, they brought in over $144 million, largely from the proceeds of their unit sales in the IPO and the private placement of warrants. They also had some repayments of related party notes. At the end of the period, their cash balance is healthy at almost $402,000. But remember, most of that money is locked up in the trust account. So digging a bit deeper into the notes, we learned that Dune Acquisition Corporation 2, or Dune Sud, is indeed a Cayman Islands incorporated blank check company. Their main goal, like any SPAC, is to find a business to merge with. They had their initial public offering on May 8, 2025, selling over 14 million units for $10 each, plus selling private placement warrants to their sponsor. It's important to note the costs associated with this IPO. They totaled over $6.6 million. This included cash underwriting fees, but also that significant deferred underwriting fee I mentioned earlier of $5.75 million, which is a big chunk that has to be paid out later. A key rule for SPACs like Dune Second is that the business they acquire must have a fair market value of at least 80% of the amount in their trust account. This is to ensure they are not overpaying or making a bad deal. They have a limited time, 15 months from the IPO closing, to find and complete a business combination, or they have to start winding down and return the money to shareholders. Now let's talk about their financial health and whether they can stay in business. As of the 30th of September 2025, they had about $401,000 in cash outside their trust account and a working capital surplus of a similar amount. This cash is meant to fund their search for a business to acquire. The report does mention that they may need to raise additional capital through loans or investments, and Tari's substantial doubt about their ability to continue as a going concern within 1 year. This is a standard disclosure for many early-stage companies, especially SPACs, but it highlights the pressure to find that business combination. Management's plan to tackle this uncertainty. You guessed it, completing a business combination. Under their accounting policies, they're following standard US GAAP. Being an emerging growth company means they get some flexibility in reporting rules, a common theme for newer public companies. They classify those redeemable class of shares outside of permanent equity. This is important because it acknowledges that this money might have to be returned to shareholders, impacting the company's true equity. The reconciliation shows how the redemption value is calculated, starting with gross proceeds and adjusting for warrant allocations and issuance costs, then adding back the accretion to reach the redemption value of over $146 million. Their earnings per S-share calculations are a bit complex because they have two types of shares, redeemable and non-redeemable, and the accounting for the redeemable shares is treated like a dividend. Essentially, they're saying that if you hold a redeemable share, you're entitled to a portion of the trust account's interest, and that affects how net income is divided per share. This section details the IPO itself. 14.375 million units were sold at $10 each. Each unit came with a share and 3/4 of a warrant. These warrants can be exercised by the holder to buy more class of shares at a certain price, 11.50 in this case. The company has an option to redeem these warrants if the class of shares hit $18 for a sustained period. This is a common feature to incentivize early exercise of warrants and reduce future dilution. Now, related party transactions, this is where things get interesting. The sponsor Dune Acquisition Holdings DLC is a key player. They initially bought millions of founder shares. There was a reduction in founder shares earlier this year when the sponsor surrendered over 1 million Class B shares. They also had a promissory note with the sponsor for up to $150,000 to help cover IPO expenses, which was repaid at the IPO closing. There is an administrative services agreement where the company pays $15,000 per month to the sponsor or an affiliate for things like secretarial and administrative support. For the 9 months of 2025, this added up to $75,000 incurred, with $45,000 of it prepaid. Here we look at how they value things at fair market value. Their marketable securities in the trust account are classified as level 1, meaning they are valued based on quoted prices in active markets. This is straightforward stuff, mostly US Treasury obligations and money market funds. The public warrants, however, were valued using a Monte Carlo methodology. This is a more complex estimation technique because there isn't always a perfect market price for warrants, especially early on. The report gives us some figures from May 2025 when they valued those warrants, including assumptions about the share price, risk-free rate, and volatility. Finally, segment reporting. Dune II, like many SPACs at this stage, is a single operating segment. Their chief operating decision makers, a group including the chief financial officer and chief executive officer, primarily look at interest earned on the trust account and general and administrative expenses to make decisions. It's all about maximizing that trust account value while keeping a lid on costs. So my take on Dune Acquisition Corporation 2. This is a company in its very early stages, driven almost entirely by the capital raised in its IPO and the investment of that capital in liquid securities. Their financial results are dominated by interest income from their trust account, not by operational business activities. The real story here is their ability to find a suitable business to combine with within their allotted time frame. The significant value in the Class A ordinary shares, subject to possible redemption, highlights the risk and potential outflow of capital if shareholders decide to pull out. Their direction depends entirely on the success of this one future business combination. The notable risks are the intense pressure to find a deal, potential shareholder redemptions impacting their capitalization, and the general market and economic uncertainties that could affect any target company. Alright, that's our breakdown of Dune Acquisition Corporation IAS latest filing. What do you think about SPACs and their business models? Does the deferred underwriting fee give you any pause? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a thumbs up and subscribe for more corporate deep dives. And once again, join our growing community on Discord linked in the description. Thanks for watching, and I'll see you in the next one.